One company in Australia is worth more than every company listed on the Greek Stock Exchange, combined. That company trades on something called the ASX. And if you have super, your money is already on it. Right now. Being invested by people you've never met, in companies you've never heard of, using rules nobody explained to you. You're an ASX investor. You just didn't know it. This video fixes that. There's a company in Melbourne right now that is worth more than the entire stock market of Greece. Not more than one Greek company. More than every single company listed on the Athens Stock Exchange combined. All of them. Every bank, every shipping firm, every olive oil conglomerate, every tech startup that country has ever listed. You add them all up, and they don't reach the value of this one company digging rocks out of the ground in Western Australia. That company is BHP. Its market value, as of right now, sits around 316 billion Australian dollars. The entire Athens Stock Exchange, the whole thing, is worth roughly half of that. One Australian mining company is worth more than a European nation's entire market. Let that settle for a second. And here's the part that should bother you. That company trades on something called the ASX. You've heard the name. It's on the news every night, right between the weather and the footy scores. The ASX closed higher today. The ASX 200 fell on global concerns. You nod. You move on. But if someone stopped you on the street and asked you to explain in one sentence what the ASX actually is, how it works, and why it matters to your life, could you? If you can't, that's not your fault. Nobody teaches this. Not at school, not at uni, not at your first job when HR hands you a super form and expects you to become an investor overnight. But here's what makes it personal. If you have superannuation, and if you live in Australia and have ever worked, you do, then your money is already on the ASX, right now. Being invested in companies you've never heard of, by people you've never met, using rules you've never been told. You're an ASX investor. You just didn't know it. This video is going to change that. In the next 20-odd minutes, I'm going to walk you through the entire ASX, from what it actually is, to who's on it, to how it works, to why one mining company can be worth more than a country, to the one thing that connects all of it back to your life. No jargon, no finance degree required. Just the version I wish someone had given me before I spent 3 years pretending I understood what a franking credit was. Here's the map. We're covering 6 things. What the ASX actually is, who the big players are and why they matter, how the ASX 200 index works and why everyone talks about it. Dividends and franking credits, the most uniquely Australian thing about our market. What actually moves the ASX up and down. And finally, the part nobody tells you, how you're already in it, whether you signed up or not. Let's go. Picture May. She's 28, working her first proper corporate gig in Sydney after finishing her master's. She's heard colleagues talk about shares. She downloads ComSec because someone at work mentioned it. She opens the app, types in BHP. The screen says $62.31, and she freezes. She doesn't know if that's expensive or cheap. She doesn't know if she's buying one share or the whole company. She doesn't know what the numbers underneath mean. She closes the app, opens Instagram, and that moment, that exact moment of confusion and quiet shame, is where most Australians stop. So let's start where May needed someone to start. The ASX, the Australian Securities Exchange, is not a building. I mean, there is a building in Sydney where it's headquartered, but nobody's standing on a trading floor shouting numbers like in the movies. The ASX is an electronic system, a digital marketplace. Think of it like Gumtree, except instead of selling a second-hand couch, companies are selling tiny pieces of themselves. Those pieces are called shares, and instead of one buyer and one seller haggling in a car park, there are millions of buyers and millions of sellers, and the ASX is the system that matches them up, keeps it fair, and makes sure nobody cheats. When a company lists on the ASX, It's saying I want to sell pieces of myself to the public. The public, that's you, me, your nan, a super fund in Brisbane, a hedge fund in London, buys those pieces. The company gets money, the buyers get ownership. And from that point on, those pieces can be traded between people. All day, every day, the market is open. The price goes up when more people want to buy than sell. It goes down when more people want out than in. That's it. That's the core of it. Right now, there are more than 2,000 companies listed on the ASX. The total value of everything on there, every company, every share, every dollar of market capitalization, is around 3.2 trillion Australian dollars. That's trillion with a T. To put that in perspective, Australia's entire GDP is about 2.7 trillion. The ASX is larger in market value than the economy that produced it. That's wild when you think about it. But here's the thing. Not all 2,000 companies are created equal. The ASX is one of the most top-heavy markets in the world, and understanding that shape is the difference between thinking you're diversified and actually being diversified. Imagine the ASX 200 as a footy team photo. 200 players lined up. But BHP and CBA are standing in the front row, arms crossed, taking up half the frame. Behind them, another dozen or so big names: Rio Tinto, CSL, Westpac, ANZ, NABE, Macquarie, Wesfarmers, Woolworths, Telstra. And behind them, 180 other companies that the camera barely catches. This is what market concentration looks like. The financial sector, the big four banks plus Macquarie and the insurers, makes up roughly 30% of the ASX 200. Materials and mining, BHP, Rio Tinto, Fortescue, South 32, makes up another 20-odd%. So two industries account for about half of the entire index. If you own an ASX 200 index fund, about half your money is in banks and holes in the ground. That's not necessarily bad. But it's something you should know. Because when someone says the Australian market went up 3%, what they often mean is the banks and the miners had a good day. If tech had a good day and mining had a bad day, the index might not move at all, even though the story underneath is completely different. Now, you've heard the phrase, the ASX 200, 1,000 times. But what is it actually? It's not the whole market. It's a list. Specifically, it's the 200 largest companies on the ASX, ranked by something called float-adjusted market capitalization, which is a fancy way of saying how much the company is worth, based on the shares that are actually available to trade. Standard & Poor's, the same people who run the S&P 500 in America, maintain the list. They rebalance it every quarter. Companies get added, companies get dropped. It's not static, it's alive. The ASX 200 is important because it's the benchmark. When your super fund says, we returned 8%, they're almost always comparing themselves to the ASX 200. When a financial advisor says, the market is up, they mean the ASX 200. When the news says, a bad day on the markets, they mean the ASX 200 dropped. It represents about 80% of the total value of the Australian share market. So when the 200 moves, Australia moves with it. It hit an all-time high of 9,198 points back in February this year. Then it dropped nearly 8% in March. Then it climbed back. That's what markets do. They breathe. Stay with me. The next part is where it starts to click. Let's talk about dividends, because this is where the ASX gets genuinely different from almost every other market in the world, and it's the part that most Australians either don't know about or pretend to understand. When you own a share, you own a piece of a company. If that company makes a profit, it can do two things with it. It can keep the money and reinvest it in the business, or it can give some of it back to the people who own it. That second option, giving money back to shareholders, is a dividend. Australian companies are famous for paying them. The big four banks, in particular, have built their reputations on consistent, reliable dividend payments. It's one of the main reasons retirees love bank shares. But here's where Australia does something that almost no other country does. It's called dividend imputation, or more commonly, franking credits. And I'm going to be honest, this broke my brain the first time I learned it. It'll probably break yours too. But then it clicks, and it's genuinely one of the most satisfying things about learning Australian finance. Picture Priya. She's a nurse in Melbourne, 31 years old. She's doing her tax return with a tax agent for the first time, spent years doing it on My Tax, figured she was leaving money on the table. The agent finishes and says, "Good news, you're getting a bigger refund than expected." Priya asks why. The agent says, "You got some franking credits from your shares." Priya nods like she understands. She doesn't. She doesn't ask. She takes the refund and goes home. Here's what actually happened. When a company like CBA earns a profit, it pays company tax on that profit, 30%. Then it takes what's left and pays it out as a dividend to shareholders. But here's the thing, that profit has already been taxed once. The company already paid. So Australia's system says you shouldn't be taxed twice on the same money. The company attaches a franking credit to the dividend, basically a receipt that says 30% tax has already been paid on this. When Priya does her tax return, the ATO sees that receipt and says, "Right, this income has already been taxed at 30%. Your marginal tax rate is lower than that, so we owe you the difference." That's what a franking credit is. It's not free money. It's a refund of tax that was already paid. It works like a receipt. The company pays, you get the receipt, and you present it to the ATO. Almost no other country does this. It's one of the things that makes the Australian share market genuinely unique. And most Australians have no idea it exists. I had to double-check the maths on this before recording. That's how unintuitive it is. Now, what actually makes the ASX go up and down? Why does it have good days and bad days? Here's where it gets interesting, because the answer is not what most people think. Picture Liam. He's 26, working as a barista in Brisbane. He's pouring a flat white at 6 in the morning when the radio says, "Iron ore prices fell overnight in Asian trade." He doesn't think about it. Next day the radio says, the ASX dropped 1.2%. He doesn't connect the two. But they're the same story. The ASX is like a ship with two engines. One engine is Chinese demand for Australian dirt, iron ore, coal, copper, lithium, gas. When China builds, Australia digs. When China slows, Australian miners fall and the ASX falls with them. The second engine is the RBA, the Reserve Bank of Australia, and its cash rate. When the RBA lowers rates, borrowing gets cheaper. Businesses grow, people spend, and shares go up. When the RBA raises rates, the opposite happens. Money gets expensive, growth slows, shares drift. Right now in May 26, both engines are running complicated. The RBA has hiked the cash rate 3 times this year, February, March, May, taking it back up to 4.35%. They're fighting inflation that's running at 4.2%, pushed higher by fuel prices from the conflict in the Middle East. At the same time, iron ore prices are softening because Chinese steel demand is cooling, so both engines are sputtering. And yet the ASX hit an all-time high just 3 months ago. Markets are contradictory like that. They price in the future, not the present. There's a whole rabbit hole about derivatives, futures, and short selling that I'm not dragging you into today. That's a different video for a different kind of headache. Now, the part that ties everything together. The part that makes this personal. Tom is 34. He's a tradie in Perth. He's never bought a share in his life. Never opened ComSec. Never watched a single finance video. One day, during Smoko, he opens the Australian Super app on his phone because a mate told him to check his balance. He pokes around. He finds a tab that says Top Holdings. He taps it, and there, right at the top, is CBA, Commonwealth Bank. His bank. The bank where his everyday account lives. the bank that charges him monthly fees. That bank is also the single largest investment in his superannuation fund. His employer puts 12% of his salary into super every fortnight. That money goes to Australian Super. Australian Super takes that money and buys shares. A big chunk of those shares are CBA, BHP, CSL, Westpac, ANZ. Tom has been an ASX investor for 12 years. He just didn't know it. And this is the thing that nobody tells you. Almost every working Australian is an ASX investor. Your employer is legally required to put 12% of your salary into super. Your super fund takes that money and invests it. And a massive portion of that investment goes into Australian shares, which means it goes into the ASX. You're already in the system. Your retirement depends on the same 200 companies that flash across the bottom of the news every night. The same BHP that's worth more than Greece. The same CBA that charges you account fees and then pays dividends into your super with franking credits attached. This part still blows my mind. The ASX is, honestly, one of the most underappreciated pieces of financial infrastructure in the world. The concentration in two sectors is genuinely a weakness. If mining collapses and banks stumble at the same time, the whole index is in trouble. But the fact that compulsory super funnels an entire nation's retirement savings through this system, creating a pool of investment capital that's now worth over $3.5 trillion in super alone, is either brilliant or terrifying, depending on how much you trust the people running it. Either way, it's yours, and you should understand it. Quick pause. If you're still here, you already understand more about the ASX than most Australians ever will. We're in the home stretch. Let me knock down a few things people get wrong. First, the ASX is only for rich people or day traders. No, every Australian with super is an ASX investor. You're already in it. Second, BHP is an Australian company, so its value depends on Australia. Wrong. BHP makes most of its money selling iron ore and copper to Asia. Its value depends more on what happens in Beijing than in Canberra. Third, index funds are boring. Maybe, but boring has historically outperformed most professional stock pickers over the long run. Boring is underrated. Fourth, and this is the one that catches people, franking credits are free money. They're not. They're tax that the company already paid on your behalf. You're getting a refund, not a gift. The money was always yours. It just took a detour through the ATO. Every situation is different. What you've just learned is the framework, not the answer for your specific circumstances. So here's what I'd leave you with. 3 things to take away. 1. The ASX is not a mysterious club. It's a marketplace where over 2,000 companies sell pieces of themselves, and 2 industries, banks and mining, dominate about half of it. Know the shape before you invest in it. 2. Everything that moves the ASX fits into 2 forces: what China wants to buy and what the RBA decides to charge. When you hear, the market fell, ask which engine stalled. 3. You're already in it. Your super is invested in the ASX right now. Your retirement depends on how those 200 companies perform over the next 20, 30, 40 years. The money is yours. The risk is yours. The least you can do is understand what it's doing. This video started with a company worth more than a country. But the real story was never about BHP. It was about you. You've had money in this system for years, maybe decades, and nobody ever walked you through the front door. Consider this your introduction. If this video means one person opens their super app tonight and actually looks at what's inside, not just the balance, but the holdings, the fees, the allocation, that's the whole point. If you want to go deeper, the Barefoot investor is a solid Australian-specific starting point. The ASX website itself has a free share market game where you can practice with $50,000 of fake money. And if you want to check your own super holdings, log into my.gov. Most Australians will retire without ever understanding where their money was for 40 years. You're not going to be one of them. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor.